Hello, and this is a special edition of Global Business Insights where we look at the 296th Monetary Policy Committee meeting of the Nigerian Central Bank and the decision to raise interest rates by 50 basis points to 26.75%. And we will comment as well on the decision. We'll also take a chat with the special guest, Wale Ajayi, Partner and Head of Tax, Regulatory and People Services in KPMG Nigeria. He will be commenting on the recent windfall taxes related to FX incomes of banks. But first, let's listen to the Central Bank Governor, Yemi Cardoso.
The committee's decisions are as follows. Raise the MPR by 50 basis points to 26.75% from 26.25%. Retain the cash reserve ratio of deposit money banks at 45% and merchant banks at 14%, and retain the liquidity ratio at 30%. The committee was mindful of the effect of rising prices on households and businesses and expressed its resolve to take necessary measures to bring inflation under control. It re-emphasized its commitment to the bank's price stability mandate and remained optimistic that despite the June 2024 uptick in headline inflation, prices are expected to moderate in the near term. This is hinged on monetary policy gaining further traction in addition to recent measures by the fiscal authority to address food inflation. In its consideration, the committee noted the persistence of food inflation, which continues to undermine price stability. It was observed that while monetary policy has been moderating aggregate demand, rising food and energy costs continue to exert upward pressure on price development. The prevailing insecurity in food producing areas and high cost of transportation of farm produce are also contributing to this trend. Also noted in its consideration is the increasing activities of middlemen who often finance smallholder farmers, aggregate, hoard, and move farm produce across the border to neighboring countries. The committee suggested the need to put in check such activities in order to address the food supply deficit in the Nigerian market to moderate food prices. The MPC therefore resolved to sustain collaboration with the fiscal authority to ensure that inflationary pressure is subdued. In addition, the committee expressed optimism with the recent stopgap measures by the federal government to bridge the food supply deficit. In particular, the 150-day duty-free import window for food commodities, maize, horse brown rice, wheat, and cowpeas, amongst others, will moderate domestic food prices. To consolidate on the gains thus far achieved, the committee re-emphasized its commitment to stay on course with its tightening cycle in view of the urgent need to address inflationary pressures. Real GDP year-on-year grew by 2.98% in the first quarter of 2024, compared with 3.46% in the fourth quarter of 2023, driven by both the oil and non-oil sectors. Staff forecasts, however, suggest that the domestic economy will grow by 3.38% in 2024, while the IMF has projected growth at 3.1% in 2024. As of July 18, 2024, external reserves stood at $37.05 billion, compared with $34.70 billion as at the end of June 2024. This represents 11 months of import goods and services cover. The global economy, according to the IMF, is forecast to grow at 3.2 and 3.3% in 2024 and 2025, respectively. Headwinds to the global projection remain the tight global financial conditions and ongoing geographical tensions associated with the wars in Gaza and Ukraine, both of which have significant impact on commodity prices and the global supply chain.
The decision by the bank's Monetary Policy Committee to hike interest rates by 50 basis points was after hiking 150 basis points in May, 200 basis points that was in March, and we had 400 basis points in February. Many had predicted seeing a lower hike than in previous meetings, though progress in taming inflation seemed to be stalling. The latest month-on-month CPI came in notably higher in June, as year-on-year inflation went up to 34.19%, far from the 21.4% the central bank is targeting to see by the end of the year. Manufacturers hoping for a pause while supply measures such as suspension for import duties on some food items had its effect will be disappointed. The data-focused central bank governor justified hiking to pained manufacturers, saying if high inflation is not decisively tamed, the far wider adverse ramifications on growth, well-being, poverty will hold back all sectors of the economy, adding that stringent policies are needed to put the country on a path of sustainable growth. The governor also spoke on the need for robust policy implementation, which requires a strengthening of institutions. The central bank is increasingly enjoying the trust and confidence of investors who welcome orthodox monetary policy and he also drew attention to unpredictability of transition gaps required to allow policies to cascade down and have the desired effect in stabilizing prices. What I missed is a comment on the central bank 21.4% inflation target for end of 2024, and indeed there was very little guidance. It should not be difficult to provide much more quantitative assessments on how MPC members see future rates and guidance on key parameters such as inflation in the near and medium term. Still, there was the good and bad. Rising foreign reserves to $37.05 billion in July was encouraging as inflation rises amid what still looks like a tepid economy given the recent slide in June PMI data. The next meeting ending September will benefit from two reads on inflation, which hopefully would have started to abate. On the 17th of July 2024, the federal government of Nigeria proposed a new bill to tax foreign exchange realized profits of Nigerian banks. The proposal is for a windfall tax of 50% on the realized profits from all foreign exchange transactions recorded in 2023. Our special guest today, Wale Ajayi, is partner and head of tax, regulatory and people services in KPMG Nigeria. He comments on how the proposal can work better to achieve the government objectives.
Under the proposed bill, the Federal Inland Revenue Service will be responsible for assessing and collecting the tax. Though the banks have the option to settle the tax due in installment, such installment plan must be approved by the FRS on or before 31st of December 2024. Any bank that fails to pay the tax as and when due or implement an approved installment plan with the FRS will be liable to a penalty of 10% per annum, together with interest at the prevailing CBN rates. As controversial as this proposed bill may be, one can truly understand the justification on the part of government seeking to explore every available source of revenue. Given Nigeria's current tax to GDP ratio of 11%, this is just not sufficient to deliver the requisite infrastructure that is required for sustainable growth in Nigeria. In the 2024 budget, the projected deficit is about 9 trillion naira, and I'm sure and I am convinced that this amount must have grown significantly since then, given the current subsidy on petrol. Therefore, the country has been relying on borrowing to finance its projects. We all know that debt is not a sustainable practice compared to taxes. As at 31st of March 2024, the total public debt in Nigeria was $92 billion. And I'm sure that this must also have grown significantly since then. The current debt to GDP ratio is in excess of 50%, which is even higher than the self-imposed limit of 40%. Though I'm not worried so much about the debt to GDP ratio, what I'm concerned about is the ability of government to finance the related interest. As justifiable as this move may be, the question is always whether this is the right timing, given the fact that all the banks in Nigeria are exploring every opportunity to meet the minimum capital requirement stipulated by the Central Bank of Nigeria. However, if the government decides to implement this bill, there are certain modifications that need to be made to the bill. Firstly, is the reference to the Finance Act 2023 as the principal act. The principal act for the purposes of companies' income tax is the Companies Income Tax Act, and this should be the act that should be referenced. So this should be corrected. The second issue has to do with clarity on the 50% rate. The question is this a top-up on the current 30%, or banks are meant to pay additional 20%? This needs to be clarified. And the third issue has to do with the ability of banks to deduct realized exchange losses. As we have realized exchange gains, we also have realized exchange losses. So the question is, can the banks deduct their realized exchange losses from the realized exchange gain? And the fourth point has to do with the need to cushion the impact of the tax on the banking industry. In most jurisdictions where windfall tax has been implemented, there is always some relief that is provided to the affected taxpayers. I proposed an investment allowance, maybe a one-off, or for a period of 3 years, of at least 10% on official investment made by banks in technology and software. This will help to enhance the efficiency of banks. And most importantly, I think it is very important for the government to conduct an impact analysis on the effectiveness of the tax to deliver the fiscal objectives and the impact on the banking industry.
Well, that's it from me on this special edition of Global Business Insights. This is Bodio Shosami. Bye-bye.